Why banks trust some people more than others. A millionaire walks into a bank. A university student walks in right behind him. The student gets approved for a loan. The millionaire gets rejected. Sounds impossible. But it happens. Because banks don't actually care how much money you have. They care about something else. Something they can measure with a single number. It's called a credit score. And despite being one of the most important numbers in modern life, most people have no idea how it actually works. Most people think a credit score measures wealth. It doesn't. A credit score measures trust. Imagine you lend your friend $100. Before handing over the money, you'd probably ask yourself a few questions. Have they borrowed before? Did they pay people back? Can they afford it? Banks ask the exact same questions. The difference is that they ask them millions of times every year. And they don't know you personally. So instead of using judgment, they use data. Your credit score is that data. Think of it as your financial reputation, a summary of how you've handled borrowed money in the past. Because banks believe something very simple. The best predictor of future behavior is past behavior. So what affects your credit score? The biggest factor is payment history. Do you pay your bills and loans on time? If the answer is yes, banks see you as more reliable. Another factor is how much of your available credit you're using. For example, if your credit card limit is $1,000 and you're constantly using $950, lenders may see that as risky. Banks also look at how long you've had credit, how often you apply for new loans, and the types of credit you've managed. Together, these pieces form a picture of how you handle debt. And now we can answer the question from the beginning. Why did the student get approved while the millionaire got rejected? Because income isn't everything. The student may have a history of paying every bill on time and using credit responsibly. The millionaire may have missed payments, defaulted on loans, or built up too much debt. To the bank, the student looks safer. Not richer, safer. And that's the entire purpose of a credit score. It's not trying to measure your success. It's trying to estimate risk. Because when a bank lends money, it's making a prediction about the future. And your credit score helps it decide whether you're a safe bet.
Like and subscribe if you want us to make more videos.